Sure, sure. That works.
Let's begin. I welcome everybody who has joined today for the sixth and final episode of the Elevate Pulse Live series. I'm Divya Sabu, your host for today. We created Elevate Pulse Live as a sneak peek into our accelerator. So far, we've hosted five insightful webinars featuring founders and key players in the D2C space. We know how challenging it can be to navigate the early stages of building and scaling a D2C brand. So I present Elevate by D2C Insider, designed specifically for founders like you who are building the next generation of consumer brands. Having already supported 70 plus founders across three cohorts with network access and knowledge, we are excited to bring you the next generation of D2C brands. Very excited to have you here with us today, Apurva. Over to you.
Yeah. Thanks, Divya. As Divya mentioned, I've been a consultant for most of my life for almost 6 years. Engineer, MBA before that, so a very typical profile if you would have it. Um, and most of it, especially since my MBA, that was 2016. A lot of my work was with either private equity firms or rather consulting them and telling why a certain product brand or market was expected to grow at what rate, whether they should invest in it. This was also for, say, global sort of private equity firms investing in India. Subsequently, I was a banker for a couple of years, and again helping founders figure out how to tell their story, how to pitch it to different kinds of investors. And of course, now I'm a VC. But yeah, for the last 8 or 9 years, I think I've been on both sides of the growth or the story deck or the story pitch deck, and sort of been reading it or refining it at either end. So so today, what I'm going to do is share how a VC, particularly an early stage generalist VC, would what they would expect in a deck, or in your opinion, 25 or 45 minutes that you spend time with them. And what I've done is sort of reverse.
Mm.
Um, Sorry, we've sort of I've reverse engineered what the frameworks, the structure that we typically use for, say, our IC decks, or even the presentations, or the the mails, the notes that we write before something even reaches the IC. So I hope that I cover most of what we typically look for in that first pitch. Please do ask questions as I go along as well. Of course, there are certain the deck is a little long, so there would be certain aspects that would be upcoming. But if you have anything on around the slide that I'm presenting at any moment, please do ask a question. I might not realize that something, you know, some particular term or some particular concept might need a bit of reiterating, and hence I might just gloss over. So please do, alert me to go deeper into it. I'll just
Sure.
share the deck. Mm, could you approve my request?
Yeah.
Yeah. So again, reiterating, this is my personal view to a certain extent, and a very generalist early stage VC sort of a view of what most pitches should ideally look like. So starting off with the fact that every startup, say when they approach a VC, are essentially they have two products to sort of pitch. One is a business product, the other is an investor product. The business product is, of course, the core of what you do, the product that you take to your end consumer or your end customer, and product that you get your your revenues from. The investor product, of course, feeds on the business product, but is very
Thanks
uh,
for-
sorry.
Yeah, I'm sorry. I'm sorry. You can continue.
Yeah, is very attuned to the person that you're talking to, right? And I don't think I can do a show of hands over here since I can't see most of you all, but I'm sure that a bunch of you have would have had pitched to, say, angels at some point of time. You would probably have pitched to, say, a D2C insider platform, or maybe angel platforms, micro VCs. You would, you might also have pitched to a VC, an early stage VC, or a family office, or ultra HNIs, etc. And when you go through this rigmarole, you realize that each of these customers or each of these investors actually have very different expectations of returns of what they're looking for from the investment that they would make into you. And hence the story needs to be uh, customized for the customer or the investor that you're going for. So please don't use the same deck or same terms and expectations, or returns projections, etc., that you would probably have used for, say, your angel round for
This meeting is being recorded.
So try to get to know more about the investor that you're going to. Try to, so a lot of times when the good founders, the really good, say, a lot of experience, maybe have worked in a big startup before this, maybe a Flipkart or an Amazon or a Myntra. They come and pitch to us. One of the questions we ask them is, why Bloom? Like, why do you want to come to us? You can possibly go and take money from the peak 15s or the access of the world as well. But what is it within Bloom that interests you so much? And honestly, some of the best of them have a very clear cut answer as to whether it's, say, a Sajid or a Karthik, or something else that they have seen and heard about the firm, some research that they've done, some DD that they've done. that has really impressed them in actually coming to us. So have clarity on who that customer is, who is not just in terms of, say, investor class, but also the firm that you're going to do some research, figure out what stands out about them. But beyond that, honestly, most uh, VCs, when you go and meet them, you'll realize that what they're doing is uh, pattern matching, mostly because that is pretty much how the mind, yeah, how it's actually a very human response to, say, going through multiple dozens of pitches every day, every week, and trying to figure out which one would win over others. And hence, what I would now get into is what the pattern is. So, what makes this investor product or pattern? We are essentially looking for four things: the team, time, traction, and timing. At different stages of the company, of your startup, different parts of these four, or different combinations and permutations would actually be relevant. Um, I will start with a very, very early stage sort of a view, pre-revenue, pre-product, a very, very early sort of a product, and sort of get deeper into it. So at very early stages, team and TAM are honestly on the risk. There's no traction. Even if there is traction, it is probably in a few lakhs, and hence not much can be said in terms of customer validation, in terms of repeats, revenue, repeats, retention, etc. From the traction. And team and TAM is actually what most of your early stage investors, micro VCs, say a source for consumer is, taking a bet on. So what works in a team? So needless to say, passion and obsession for building. And by the way, I'm probably going a little fast. Please do interrupt and ask questions from the audience as well, as and when you want to.
Yeah,
Uh,
sure.
yeah. So needless to say, passion, obsession for that vision, mission is what we're looking for. A lot of times founders come and ask, hey, I want to build something in, say, electronics. But most of my, experience or career has actually not been in anything related to electronics at all. Honestly, it doesn't matter. I think we've all seen great examples of how founders from completely different backgrounds, a lot of them from a consulting sort of a background, came out and built really good products in all sorts of categories throughout the D2C era in India. So it's honestly, when the VC is actually talking to you, it's your obsession with some building something in that space, in that category, that matters the most. What matters apart from that is a unique consumer insight. Say a founder once came to me and said, women wear very women have started wearing dresses with low cleavages nowadays, and hence they're very conscious about pigmentation on the chest. And I want to build a body care cream that targets this pigmentation. And that was like a very specific sort of an insight, right? It sort of, maybe, for all I know, the founder might not even be building that particular cream only for the next 10 years. And obviously you can't really build around just one product, but it gave me the idea that, okay, there is a lot of clarity of thought, a lot of in-depth research that has gone into him reaching a point where he wants to build a product for this particular kind of an issue. Um, Intent to execute for the next 10 years is, again, very crucial. We, of course, as most of you would know, VCs function on an 8+2 10-year sort of a fund cycle, and we expect and hope for and pray for returns within that 10-year cycle. So it's and of course, different VCs would have different opinions on this particular matter. But for most generalist VCs, when a founder comes in and talks very exuberantly about how acquisition could be a great exit for them in, say, the next couple of years or 2 or 3 years, it is honestly a little confusing for the VC as to why they should be, uh, uh, investing or participating in a journey which the founder themselves don't see going beyond, say, a 2 or 3 year mark. So learn a little about your investor before you go in with a pitch, which also sort of showcases an acquisition as a plausible exit. So for most, a lot of times for VCs which are very sector specific, which were, invest in, say, only consumer, only SaaS, etc. Plays like this are still fairly okay. However, for a lot of generalist VCs which probably invest maybe a fraction of their entire amount of checks in one particular sector, an acquisition sort of an outcome is typically not that great. So do understand who you're pitching to and pitch your end state outcomes accordingly. And of course, everybody wants to invest in a founder who sort of has the vision or the gumption or the chutzpah to sort of take something all the way to an IPO or a unicorn sort of an outcome in the next 10 years. But when you do pitch that, do have clarity on, say, what is the broad road to that unicorn sort of an outcome, right? How much capital would you need? And you wouldn't believe how many times when I ask founders that question of, okay, so if you grow from this 5 CR sort of an ARR to a 500 CR ARR, how much capital would you need? Mota mota. I'm not even expecting like a very clear answer. But more often than not, they do struggle because, uh, or I get a really odd answer like, hey, I would probably only raise like a very small amount or a very maybe just one round or something like that. So have that clarity. Go talk to as many senior founders as you can, or even folks who have been through this journey, right? And that brings me to the third point, which is familiarity with VC, with the whole VC game, so to say, of how you raise and how you raise again. What are the metrics that, say, a seed VC would look for versus a pre-series A versus a series A? And of course, all the metrics, benchmarks, traction requirements are different for each. But it is so much, I don't think it's a make or break sort of a factor, but it's easier to push through an opportunity or a venture through the IC with a founder who knows how to speak that VC language, uh, who knows who's and the only way to learn that VC language is of course to speak with other founders who've raised before, who have been through that whole rigmarole of raising and then raising again and then raising again, and are sort of very familiar with what that entails. And it's not just about metrics, but of course about the general attitude of, say, valuation, equity, etc. as well. Uh, Ability to hire and retain, complementarity of skills of the co-founders, um, fairly intuitive as to what they mean. So I wouldn't go too deep around it. Of course, we do ref checks, etc. So there's not a lot that you can probably portray or pitch perhaps during the pitch for both of these points, but still good to know that the investors would be looking for all of this. We of course do always check. We like to know how the founders met, what they have done in the past, and how complementary their skills are, in the sense of, see, there's typically one founder who's a great vision seller, and typically that is the kind of composition that we've seen in some of the better teams. And there would be another who's really good at just going knee deep into execution and operations in the back, right? So that is the kind of complementarity that we're possibly looking at. Again, pattern matching, if you will. And if you have that in the team, please do highlight it, please do talk about it. Ability to adapt, again, is something um, which which I really like to hear about when I'm on a pitch. So from the time that you start the venture, in fact, with a bunch of early stage ventures that I'm tracking, from the time that they started, from the time that we first met, some of the teams have actually broken up. The product, some other teams, the product has changed entirely. The story is developed so much over just 12 months of operations, right? Please do talk about that. Please do talk about the initial um, vision that you had, what you started off with, and where you are now and how you got here. And it all matters a lot to the VC. It tells us a lot about how committed you are to the cause, how far are you willing to sort of go to, make this into a reality. Kitna hustle hai, kitna grit hai, everything sort of is dependent on that, or rather is shown from that story. So please do talk about your entire journey from the day that you Of course, don't take like 15 minutes to tell it. Take a few minutes, but do touch upon it as much as you can. The last thing, of course, is not mandatory, and it's not um, possible also for all teams. But do talk about any unfair advantage that you have. A small example could be something like having a family background in, say, contract manufacturing. And this, I think, comes to top of my mind because a lot of founders that come my way are from such backgrounds wherein they are taking their family business or what their family used to do as a business into a whole new form, into as a brand, etc. Not just in India but also abroad. So do sort of highlight that we shouldn't have, a lot of times I have to dig into the founder's background and sort of ask about it. Okay, what is your family into? And then I realized that okay, there is a lot more experience and familiarity hidden, and dinner table conversation sort of level or sort of experience hidden that the founder hadn't actually highlighted. So please do, if you have any unfair advantage, please do highlight all of that. Beyond team comes TAM. And when I
Um,
say
I'm so sorry to interrupt, but I actually have a question regarding, like, the team. So if the credentials of the team or the founder isn't impressive or isn't up to the mark, is it preferable to get at least like one mentor before, like while starting, like while you're building your business?
uh see, honestly, if your mentor is, say, Mr. Nagesh of Shopper Stop, who's a promoter, the founder of Shopper Stop, or someone of that caliber, right? It of course gives a strong impact for a bit. Like it jolts investor. Okay, this guy probably, this guy knows this person and is probably getting mentorship. Might this person might actually, this mentor might actually help open doors in the future, etc. If it's not like a very, very strong profile, honestly, as an investor, it doesn't make too much of a difference. Even when there is, say, a very strong profile, I would still evaluate the rest of the business with as much scrutiny as I would without that mentor. So the mentor is more of, you know, more of, I probably shouldn't say it this way, but more of a brownie point when it comes to the entire scheme of actually evaluating an opportunity, and not as much a deal making or breaking sort of a thing. So uh, even without creds, I would not mandate a mentor or an advisor or someone like that on the board. It of course uh, it does help the case if you come across as someone who's able to reach out to the best of the best, say, angels in the country, or the best of the best mentors, and it tells us something about how you built your network and how good you are at actually convincing people to join you as advisors and mentors. But again, that's more of uh, that's not a must have. That's a really great to have, but not a must have for us per se. Yeah.
But yeah.
So on the TAM, a lot of times I feel like uh, founders sort of give a number, but then I actually have to go back and still calculate what the genuine time for them is. For example, say Denimwear brand is pitching to me and quoting the number for the apparel market in India. But the honest truth is that there are multiple cuts before you actually come to the denim wear market size in particular. So please make sure that you're always, pushing the bottoms up. TAM is how we call it internally. I don't know how it's called otherwise, but the most relevant time for you, right? So in the case of a denim wear brand, it's not only apparel and not only Western wear, but actually denim wear specifically. Um, it matters if your category or your product is sort of hair on fire. That does help, but there are a bunch of these other categories in which you might actually also need to educate the investor. And it's not just for new categories, say a certain kind of supplement. Like I feel like the only reason that I know a lot more about the supplements and the kind of things that I need, the kind of nutrition that I need for my body, because I've been pitched to by a lot of supplements brands, right? So if you're creating a category, there is definite education that you need to do for the investor. And again, you can't spend like 10 minutes just doing that. very specific sort of consumer insights, very specific margins, market dynamics. Say if you're, I'm getting a lot of pitches for distraction-free laptops, right? And this was a category which is very new to me because it functions in a very different way. It's very offline, different kind of market dynamics. It helps if the founder can very, quickly and gently sort of educate me on all of that. So be prepared with all of those, say, consumer insights and market related educational sort of stuff. In some cases, for example, say ethnic wear, what has happened surprisingly is that more often than not, and maybe this is not relevant for all the startups present on the call right now, but more often than not, the investor that you're speaking with would be male because that is just how the ratio works within the industry. So be prepared in cases wherein you feel that the male investor might not be as familiar with the end product that you have. Be prepared for questions around very basic sort of questions, also around, say, what the consumer behavior, consumer needs sort of look like, right? And this we've faced quite a bit for something as simple as ethnic wear because it's very, I think it's a lot more intuitive for most female investors to sort of grab on to say what a Fashor's, Fashor is one of our brands, Fashor's, say, positioning is vis-a-vis a male investor who typically doesn't shop for, say, his daughter or the wife, and hence is very, very unfamiliar with the market. So it's not just category creation sort of cases, but also, such mainstream sort of things that you might need to, educate the customer, the investor on. Um, Paths to unicorn IPO outcome. Again, just reiterating over here. Know how much, like, know the entire math. Please don't dole too much of it onto the deck itself, but know the entire math as to how large that bottoms up TAM is. How much market share would you need to eventually make like a unicorn or an IPO outcome in that market, and how much capital would you need to get there. Be very, very well versed with that end state, and what your company looks like at that moment. Whether you'll still be, selling the same products, does it become into a platform, does it still stay in the same shape, does a product mix still remain similar to what it is today. So have as much clarity as you can on that front. I know in a very, very early stage it might not be very possible to have everything down to the final number, which is fine. I think everybody's only looking for high level sort of insights, and all investors know that by the time, maybe even like 2 years into the investment, the shape and the form of the company is going to change quite a bit. But yeah, have as much clarity as you can to sort of speed through this. Yeah, this is a question that has been asked by a lot of founders, even that we work with, which is whether team is more important than TAM, or the other way around. Honestly, in the early stage, I would always put team over TAM. In fact, a lot of our larger companies, say Slice, Ultra Human, etc., started off with very different sort of products. Eventually, ended up with a whole different kind of a product. But we really believe in the founders. The founders sort of convinced us that they were the best team to be building. And I think the broad vision, right? Say for Ultra Human, the vision was always to help people track their biomarkers. And today, the product that is live today is very, very different from what they pitched to us many years ago. But the vision of the founder was very strong from day one. He was able to convince us very, very clearly that he was, the best team to be building it. He was very committed to the cause, and hence it was a team that we honestly invested in. In fact, we have another venture called Chimera. It's now called Chimera. It was earlier called Relove. Again, very committed founders to the whole fashion tech space. They tried re-commerce. They tried something else before that. Kept failing. Pivoted now to Chimera, which is an AI fashion photography thing. But honestly, 2 years back, had you told me that this is what they would be doing, I would have probably laughed at you or something like that, because it was just so different from what the initial product was. So honestly, you need to, if you're early stage, if you're pre-revenue, just sell yourselves as the best team out there to execute the vision that you have. That said, if someone comes to me and says that they want to build in, say, the space for pet toys, and that they have a very big vision in it, etc., will I invest? Possibly not, because the market seems like a very niche and small market to begin with. So, of course, there are certain constraints like that, but honestly, it's a team that we invest in the most. When you come to revenues, even say once you're sort of an MRR, of course, vis-a-vis of 3 years back, which is when I joined Blume and I started investing in the consumer space, I feel like I find companies are reaching the 1 to 3 CR MRR sort of benchmark a lot faster. A lot of it is because there are so many channels now to sort of push from, and hence it actually becomes, my life as an investor actually becomes a lot tougher, because I don't know what to mark as sort of too early and or too late, which is why I now start looking at revenue quality. Because honestly, from a very, very early, like a early traction, 10 lakh, 20 lakh MRR sort of a stage, to a 1 to 2 CR MRR sort of a stage, because of the fact there are so many channels pushing your product, uh, the the whole digital selling bit has become so much more empowered, right? It is, the risk actually doesn't reduce as much. The product can still fail. The product can still fail to click. So we are focusing a lot on revenue quality. So when I say revenue quality, I mean, what are the, say, channels that the money, or the money coming from, or the customers buying from. If you have a favorable sort of a revenue quality, which means that if a lot of your revenues are actually coming from your own channel, your own D2C, you own the customer, as they call it, please do highlight that. Please do, do pitch around that. Make it a very key point of the entire pitch. Um, if not, please do be straight about it. It's very, disheartening once you hear, say, if you're talking to a founder doing, say, 3 CR in electronics per month, and then you get to realize that, okay, this is, say, entirely from Blinkit, or say the reverse for, or say Mintra for apparel, right? A lot of times I do get pitched to by brands doing 80 or 90% of the revenues on Mintra. Please do be straight about it from the outset. So I shouldn't have to, if the investor then digs into your revenue quality or your channel splits, and then realizes that, okay, a lot of it is actually from marketplaces and or quick commerce and not own channels, it actually diminishes their opinion of how the data was presented in the first place. So please do celebrate your revenue quality. If you have a lot of, if it is of a very high nature, or even if it's not, please do be straight about it in the first place. um, the rest, of course, if you have great margin structures, if your returns are low, you have very clearly defined hero products, some SKU is working very well, or your inventory aging is very low, please do celebrate all of these points very clearly on the deck. Because in the initial months, years, honestly, there's not a lot of data, not as many cohorts that we can go by. But all of these are very promising sort of indicators when it comes to, like, very, very initial sort of signs of PMF. So yeah, I just missed one point around the product, and I've sort of put it in green over there. I just realized. Um, so the product part becomes important more so because anytime I talk to a founder who's very passionate about the kind of product that they're building, it gives me a lot of confidence around just their obsession about how they want to build, right? And honestly, most brands, 99% possibly brands today are contract manufacturing stuff. But at the end of the day, it's the product quality that that truly wins customer love. So unless and until you're genuinely obsessed about it, it's very hard that you would be able to retain the customer in the longer run. For example, so in fashion, the co-founder Priyanka is super passionate about squeezing in as much value as she can with every SKU that she's designing. So the best of the fabrics that she can afford, the best of the embellishments, etc. And that does impact their margin structures a bit, but at the end of the day, she has a lot of customer love for that. So I do. Most investors actually do look out for that, product love, or rather, product obsession in founders to see, whether or not they would actually be able to build a brand one day that the customers can, truly love. Yeah, I'll just move on to the last bit of it, which is timing. So, um, of course, it helps to be early, whichever category, sector you are sort of building in. It helps to be one of the first brands into it. But also doesn't help to be too early. I think category creation is expensive. We all know what happened with Rebel, but a lot of the cloud kitchens that came afterwards are having a lot easier a time because of the fact that now we are so used to, ordering from aggregators, etc., ordering outside food all the time. So be very aware of just how mature the market is. A lot of times, yes, there would be a bit of push and a pull to genuinely convince the investor that, the market is actually ripe for an investment now, uh, and that there is a genuine first movers advantage, which possibly wouldn't be too expensive at the moment. For example, someone just told me today that um, there are a lot of Gen Zers, or other college kids in a bunch of colleges in Bangalore who actually prefer kombucha over Coke. And honestly, like, that blew my mind because my college days were definitely not like that. I don't think I was even familiar with the concept of a kombucha at that point of time. But today the scene is clearly very different. The price sensitivity is very different, interests and awareness around, say, health, etc., are very different, right? So the moment the founder tells me such a statistic, I start looking at the investment in a very different way. And my mind opens up a little bit. Even then, I'm more inclined and incentivized to sort of go deeper into what they're building instead of just writing it off, saying, okay, maybe the market is not ready for it. I'm now more likely to first research what this younger generation truly sort of consumes rather than writing off. So uh, please do research, please do use as much, and I keep saying this again and again, please do use as many consumer insights specific to the sector or category that you're building in as you can. Um, the why now question is, of course, also related. I think 5 6 years, or maybe 6 7 years back, I would probably not even have taken too many pitches around supplements because it just didn't. We are not traditionally very wired to take supplements, etc. But now supplements, proteins, everything is being consumed in plenty because that's just how the consumer is thinking now. So be as prepared as you can about the timing of the venture. Please do add a slide on it, if especially if you are into a category which is either too new, or you're trying to create one, or you're trying to create a new form factor or something like that, right? So do focus on the timing bit as much as you can for new ones. Um, yeah. Okay. So that was, I think, the end of my pattern matching bit. Let me know if you have any, if anybody has any questions, and then I can just move on towards the do's and don'ts because I think I'm running a little late anyhow.
So there's one question which says, can you please explain bottoms up TAM with an example?
Sure. So I think I did use that example. Let me use a slightly more complicated example, more because there was an IC on something similar very recently. So say the anti-diabetics or the diabetics drugs market, right? Say if you're pitching something in the drugs market, it is one thing to say the diabetes drugs market in India is, say, so and so billion. Um, it's another to actually drill down to the kind of patient base that this, or the size of the patient base that your drug is the most relevant for. And This could be like an age restriction. This would also relate to, say, the pricing at which you're selling the product. Is it going to be a very massy consumer? Is it going to be a very affluent consumer? Is it going to be someone in between? And all of that would actually determine the size of your TAM. So use all of those, not just the use case, but also the pricing bit of it, the demographic bit of it, to genuinely come to a bottoms up sort of a TAM calculation. So just reiterating my previous example also, what I meant was a denim wear brand, say something like a Freakins. Freakins didn't say this to me, but something, Freakins is a portfolio company. They do denim wear and bottom wear in general. A Freakins pitching just apparel market size to an investor doesn't really mean anything, or apparel market size in India, or even a Western wear market size in India doesn't really mean anything. I think the most useful stat for an investor would be the denim wear market size in India, and what the, say, the consumer behavior around that is. How many times does the consumer actually buy denim, say, in a year? And over and above that, what is the customer base, or the size of the customer base which would actually buy, say, denim wear at that price point? All of that sort of relates, right? Because um, people who buy, say, a Levi, or not even a Levi's, say, folks buying, what is that Hrithik Roshan brand, HRX, right? And HRX denim wear are possibly constitute a smaller base, a larger base as compared to someone buying from a Mango, right? There are fewer people buying Mango jeans as compared to HRX. So be very conscious of which user base, which customer base you're sort of talking about. I hope that helps, but we can connect offline if it doesn't.
Got it. I think we can move on to the do's and don'ts part of it.
Sure, sure. So starting with the first one, please don't reinvent the flow. A lot of times, not a lot of times actually, but maybe 2 out of 10 times, someone pitching to me would be using a very different kind of, margin structure profile. Say no CM1, CM2, just a different kind of a margin, or something in between. Or they would be calculating CM1 and CM2, but in a very different fashion. They would not be taking the same costs as most other brands do. And honestly, nobody benefits from that. No party, neither the founder nor the investor, sort of benefits from um, you know confusion from that can occur because of these changes in flow. The same applies to the deck as well. These 10 things are the core parts of any pitch deck. Of course, if you're very early, you wouldn't have the traction slide, but apart from that, most of these are the essentials that your pitch deck needs to have. Please don't play too much around with it. Um, I meet like 50 founders or 50 teams typically over a quarter. And these are like unique startups or unique companies that I'm meeting with. Um, if I'm meeting 50 over the quarter, which it means that I must have seen at least 5 times that pitch decks, right? So I must have seen around 200 to 50 pitch decks within a quarter, which means that my eye is actually trained to, follow a certain flow, follow a certain pattern, and read very quickly whether or not that particular team, that particular venture is actually applicable or relevant for us in terms of stage, in terms of thesis, etc. So it helps to follow a certain kind of flow instead of trying to be very creative with it, to do a video deck, etc. Yes, it does uh, make a great impact if and when the investor does have the bandwidth to actually go through the video deck. But I always encourage founders to send like a readable sort of a deck along with it, because of the simple fact that most investors, when they open their email and they look at the deck, they probably look at it for a 30 or 45 seconds before their mind starts saying, yeah, this looks relevant, this doesn't look relevant, right? So don't play too much around with it. um the first 5 minutes are very, very crucial. They pretty much make or break um, the conversation, and not make or break, but they do impact how the investor sort of leaves the conversation, or what the investor takes away from the conversation. Um, don't so focus on the story. Don't let the slides sort of determine what you want to say. Use the slides as an anchor. In fact, some of the best pitches that I've had have been conversations and not like, like people running you through the deck. So do check if you're possibly better at having more of a conversational pitch versus a deck based pitch. Please do, as an investor, please do try to push for a conversational thing. A lot of times founders sort of get stuck in the flow and are not able to and lose track of the story that they're trying to tell. So use your deck or slides as a support and not like the center of your pitch. If you have a product, if you're meeting in person, please do bring your products. I'm astounded by the number of times that founders don't actually, they have a novel sort of a product or a very different thing, but they don't actually bring it to the meeting. They don't, even have it with them on the video. So please do try to showcase your product as much as you can. Do show demos if you have, if you're say a platform or some sort of a SaaS service. Um, Share your consumer insights, ask questions, keep it conversational, right? But do make sure that you have every bit of that investor's interest in those first 5 minutes. When I say ask a question, it can also be something as simple as, hey, what have you seen as an investor working in this particular category or in for this particular set of founders or from some particular prior investment of theirs. But yeah, please do make sure that you don't bore. It's not so much about boring, but you don't lose any investor interest about in the first 5 minutes. Don't do information overload. A lot of times I open the pitch deck and there is this entire table from Excel sort of pasted in the projection section, and it takes a minute for me to figure out which row, what to read, etc. Uh, Please use your slides very wisely. Think of them as very, very precious real estate that is meant to, you know, sell the best parts of your company. Don't. No one wants to read a 30-page deck. I Even if I get a 30-page deck, I have to sort of skim very rapidly through it. Please don't attach or include, say, entire screenshots and large excerpts from, say, a KPMG report or an Aventus report. So honestly, if I wanted to read the report, I would just go there and read it, extract the most important sort of insights or data points from it, and just put it in a normal sort of a text or way or visual or whatever it is. But please don't dedicate too much to numbers. Don't dedicate too many sites to just stats and media, PR sort of articles, right? All investors see their own portfolio doing a lot of PR, so they know exactly how it is done. So please use your slides for the genuinely value additive sort of stuff that you can tell about your company, right? Every slide should have a very clear purpose, a very clear proposition. It should generate a very positive sort of an emotion in the investor. So treat your slides as very expensive sort of real estate. You shouldn't be just dumping in stuff that you think the investor would want. Wait for the investor to ask those questions, and they will, of course, come eventually. Don't include the ask for the round size or even the valuation in the deck. Um, and yeah, this does happen. I get decks with very specific sort of, I want 2 million for 15% equity or 10% equity, right? I feel like ek to you are possibly sending this deck to 50 investors or maybe 100 or 200 investors. And each of these investors would have very different sweet spots in terms of the check size, in terms of what they think is the right stage for them, right check size for them for that stage. We at Bloom do a variety of check sizes from say 2 million to say even 5 million at times, depending on what the background of the founder is, what the sector is, etc. So don't decide that for the investor. You can check with the investor once you are on the call, but please don't put the round size in the deck. You can, of course, investor would want to know how much you're raising, possibly even before the call. That does happen. Please do your research on that particular investor in that case, and quote a figure that is that you think might be amenable to them. Quote a range that you think might be amenable to them. A lot of times when we go out for fundraising for our own portfolio as well, we do go to different investors with very different asks, because that is how variable. Like, we can go for a 6 to 7 mil to an 8 to 10 mil, or maybe even slightly higher, depending on which investor we are talking to at that moment. So please don't fix that negotiation at your end. It is the buyers or the investors right, and it's the onus is on them to sort of price it out. So they should actually state a valuation and negotiate with you on it, instead of you just fixing it for them. So yeah, so please don't include either of the figures on your deck. Update your deck. A lot of times, I know that all founders want to just focus on their dhanda, and even our own portfolio founders get so antsy when they've been raising for say a few months, and they're like, I want to get back to the business, I want to go back to building. So I know it's very painful, but it's unfortunately so critical to your fundraising journey, right? So please do focus on your deck. The deck that got you your angel funding or your pre-seed funding, or even your pre-series A, will not be relevant anymore for series A. And the same goes on for all rounds beyond, right? So you can use the same designer, you can use the same people who design your prior decks, but do change the meat of the deck with each round and focus as much as you can on it, because honestly, a lot of times your product mix, etc., might also have changed by then. So do focus on the deck. Um, Yeah, there have been cases, and this is not just about the 30 minutes of pitch, but reaching out in general. There have been cases even within the firm in which, say, a founder went and pitched to one partner, and was passed. The partner passed on the company, and then the founder went and sought meeting with another partner who was sort of in an overlapping sector. So this typically wouldn't happen with, say, a consumer brand partner versus an EV partner, but there are always overlaps when it comes to different sectors that partners look at. And there have been cases even internally wherein the second partner actually took this founder or the company all the way to the IC, right? And we also eventually invested. So different investors would have different sort of investor founder fit. Okay. And um, investing is a very subjective thing. There are always multiple reasons to say no. Every individual is always impacted by his or her previous investments, what kind of things he or she has seen in the market, their own biases, etc. So please don't just pause with one partner. If you get sort of if you hear a no from a firm, do try to reach out, and do try to reach out to folks who you think might still be relevant within the firm. Yeah, sorry, I just realized that was the last slide. But any questions, please do ask. Happy to go deeper into any of these.
First of all, thank you so much. I'm pretty sure everybody learned a lot. So we do have a couple of questions. So the first question is, in your experience, what are some unconventional elements of a pitch that you've come across, like in your professional experience?
Oh yeah. Can we come back to
Sure.
that? I can't recall anything right now. I'll just sort of think about it and come back to that. Yeah.
Yeah, sure, no problem. So another question is that you come across a lot of people who might either be shy, overconfident, or rigid. So how does a founder strike the right balance between confidence and coachability, like during a pitch? And how can they also show that they're open to feedback without coming across as a little unsure?
Um, so first of all, I don't think all investors want coachable founders per se. I think uh, we we do, of course, still understand that there are certain aspects. It's like what Seema Auntie says in Indian matchmaking, that you would never get 100%, you'll probably get 70-80%. It's a 70-80% that we look at from a business perspective, but we always know that there would be some 20-30% that the founder would need help with. And that's really fine, right? As in, see, I think it all boils down to the attitude. A lot of times when we question something when you question an insight or sort of do a rebuttal for something that the founder is trying to say or trying to pitch, we get a lot of aggression back. That is typically a turn off. Like we do have this uh, when we do our ICs, we have this small question tucked away in a corner which says, "Will the founder listen to us?" And I don't think the question means, will the founder listen to us around how to build the business? We can't bloody build the business. If we could, we would have done that. But we do have visibility of, say, things like fundraising, what say follow-on investors do like to see in a venture, what we have seen other founders sort of try and fail. So there are these patterns that we know, and hence you would always try to nudge the founder to try to drive the founder to sort of at least look at them. But if there's a lot of like, if we are saying something and we get a lot of rebuttal from the founder for everything that we're saying, it does sort of um, communicate that maybe the founder is not as receptive to feedback. I think the best founders sort of figure out how to at what point to sort of just accept the feedback in a very to each his own sort of a way. But I think a lot of it is judged from the kind of attitude that the founder is showing, is exhibiting. In terms of, hey, do we judge a founder who says that, who seems to not know a particular thing like branding, for example, like, or even there are founders who say, see, we can build till say 300 crores, but we would need a bit of brainstorming and a bit of support to figure out how to build, say, to a 600, 800 crore number. Or we or we realize that they're not as familiar with the whole fundraising scene in general. They're not very familiar with how the VC game is played. That's fine. As I said, 70-80% is what we look for. And I don't think, as long as the core execution skills are there around building the business, I don't think we mind even if the founder is very candid about the fact. And that does happen. They say, we have these people, but we need to hire people for these because we don't think we have the DNA to say do very very good marketing, or we don't have the DNA yet to do very good customer service, and hence we need to sort of bring all of those on. And that's fine. We're actually looking for people who are very straight about it, instead of us sort of pushing and trying to open their eyes to that reality. I hope that answers the question. Please do ping again if it doesn't.
It does. And I think, I mean, just learning how to take constructive criticism is also just really important for any human being. And
Yeah.
so,
Yeah.
okay. So another question is that, I mean, we all know D2C brands are just heavily driven by consumer trends, right? So how do you assess whether a founder's pitch reflects sustainable demand or just like a passing fad? I mean,
Sorry, could you repeat the question?
so like, how do you, since the D2C space is just like very much driven by consumer trends, how do
Uh,
you assess whether a founder's pitch reflects sustainable demand or like if it's just like a passing, if it's just not gonna be relevant into, yeah.
Yeah. Um, as I said, as in, I know I said consumer insights like 5, 10 times
Mhm.
during the entire presentation, but honestly, it's actually a lot of that. Uh, it also reflects in the clarity of thought um, that the founder has put in and genuinely calculating the TAM that he or she is addressing. Uh, and a lot of actually is also dependent on how um, yeah, I think it's clarity of thought, etc., that matters the most. It's very easy to tell, yeah. So when we are actually getting into a pitch, or even if you look at a pitch deck, it is fairly easy to sort of figure out, say if it's like a patch form of supplements or something like that. It is sort of easy to ascertain, and investors jump to that conclusion fairly quickly, हाँ, कि अच्छा ये तो बहुत छोटा market है, या तो ये कैसे supplements ही कैसे grow होंगे, फिर supplements के patches कैसे grow होंगे. So वो सब fairly easy होता है. I think if the founder can genuinely answer the why would they be the next unicorn, or why would they be able to say get to a 600-700 crore number within the next 8 or 10 years, if they can genuinely answer that question very well, the investor should not have as much of a problem in with the TAM that they eventually end up with, or the trend that they eventually decide to follow with. If the trend is matching that equation, there is the investor wouldn't have a problem with it. But sadly, most trends that come by don't match that equation. They're very faddy for the most part. Don't constitute a big market. If the founder feels that there is a bigger market to be had, or if there are some pivots or some changes in their mind in the product roadmap or the company's roadmap, it does help to have that kind of a clarity upfront in the pitch deck. So we do get pitch decks in which they say, okay, we'll do this for now, and then this is what we want to be, right? This is the end state that we want to be. This is just the GTM in one way or the other. So that kind of clarity then needs to be put out very explicitly in the pitch deck itself, or during the pitch, one way or the other.
Got it. We can do the last two questions. There's a question. What is edge founder get in fundraising if they're a second-time entrepreneur?
What does edge founder mean? Oh, like a no,
Uh,
unique profile? No.
I mean, I think they can comment in the chat box and we can move on to the second question.
Second time entrepreneur, I'll still answer.
I've been a founder before, just a second time entrepreneur.
We sort of, park a lot of value in that second time founder tag. In fact, the moment someone is describing a pipeline company that they have met in the past week, and we do have these pipeline meetings every week, the first thing they say is second time founder hai, and everything, right? So we value a lot. We put a lot of value in that second time founder experience, or rather, in the founder having had, say, a startup before, regardless of how they exited. Of course, if it's been a really good exit, then the value of the founder also goes up significantly. But even if it's not been that, shows a lot of grit and commitment to sort of, for a founder to build all the way over again. So there have been times wherein we've actually invested much higher amounts also than we typically do, mostly because the founder was a second time founder, had like very great ref checks from the previous investors, from the folks he used to work with, from the folks who were his employees in the previous startup, right? So yeah, I think if you are a second time founder at Blume, at least you would get a lot more like equity, brand equity, than you would otherwise. We do respect that quite a bit. We are open to taking larger risks with such founders than we would be with someone who's building for the very first time.
Yeah, they've gone through the experience before, so they would not make the same mistakes they did before. Yeah. Okay, this is a question that I get a lot as well. So it says investors tend to have a lot of questions after a pitch. So what are some of the toughest ones founders should be ready for in general?
I don't know what founders find tough when I ask them. But see, so I was doing a pitch call today, and I asked the founder, okay, so they are building this beverage sort of a thing, and I was like, okay, so you want to make a beverage for, say, just to address, say, gut problems, but do you then eventually want to get into immunity and maybe like fertility, just of the and there are the other conditions that you want to address? And someone who's overhearing said, key, isn't that a very leading question? Like you're literally giving the founder the answer when you're asking the question. But that wasn't the purpose. So the purpose behind that question was to see how much depth have they actually gone into, how much clarity of thought they have. Are there specific consumer insights in each of these categories that they've already seen and loved, and they have a very clear mental view of what they want to get into next and why they want to get into it, what that particular TAM looks like, what that particular consumer looks like, would the consumer sort of overlap, will the immunity consumer sort of overlap with the gut consumer, etc. So it's that clarity of thought that I'm looking at. So honestly, any question that the investor is asking you now, it's always because they have looked at the deck and they've come to a conclusion in the back of their mind, and they're trying to validate that conclusion one way or the other. So I would say any question is sort of a tough question in the sense that please do share as much insight, and do showcase whatever planning, thinking that you've done before for that particular venture, right? So treat every question as a very as a leading question. And honestly, even when you're giving the pitch, and I didn't mention this before, please do read cues from the investors. We all come with very, and it's only human, but we all come with very set biases against a category, against a particular way of building, against a business model. And the way we ask the question, the way we frame it, the question that we ask, everything will tell you a lot about those biases. So please do read as much as you can. I know it's very easy for me to say that, but it's much harder to do that. But the investor would very clearly, indirectly, but still clearly tell you what is it that they're most skeptical about. So please do grab onto those opportunities and try to allay those apprehensions as much as you can.
Okay, thank you so much, Apurva, for taking out the time and doing this. A lot of insights, a lot of perspectives to everyone who joined. So, yeah,
Um,
thank you so much.
Yeah, thank you for having me. And someone has asked how to reach out to Bloom Ventures. Honestly, you can just do first name at bloom.vc. So please just go ahead and do that. Any team members' first name at bloom.vc. Yeah. Thank
Thank
you.
you.
Thank you. Thanks for having me. Thank you, everybody else, for listening to me for so long.
Thank you. Thank you for being a part.
The recording has stopped.